I lead software group solutions for banking, financial markets, and insurance. I've done that, I think, for the last 2 years or so, and I live out of a plane. So even though Boston is my hometown, I'm very rarely here, and it's great to be here. It's great to talk to you all about local things that are important to our industry, like Wall Street's most watched Senate race, who's going to win, what's the impact on regulations, etc. And probably more importantly, what's the impact of Kevin Youkilis's trade over to the Chicago White Sox? Because I think that's probably going to have much more impact on the city of Boston than our Senate race. So today I'm going to present to you our most recent series on the CXO. It's a CEO study. We've done 5 of these over the course of the last, let me just bump ahead a little bit. We've done 5 of these over the course of the last 8 years, I guess. To date, we've interviewed, I think, something like 5,000 different CEOs. In this last one, we had 1,700 participate. It's much different than typical studies that are done over the internet, where you just have a series. Sorry, I think I just cut out. Okay. Where you just have a series of questions that are answered by the respondents. We do that type of question, but then there's detailed follow-up and interviews where customers and CEOs are asked detailed questions in terms of what their responses were and what it meant and what the impact was. So quite a bit more unstructured information than a typical survey. So we think it's the biggest of its kind. Now we have, as I said, 5,000 different CEO interviews on record over the course of the last 8 years. And as you can see through this slide here, every year it grows. So let's think in 2004, we started with 400 CEO interviews. Now we're up to 1,700, and it's progressed that way each time. A little bit about the type of people that we've interviewed for it. So it's not just financial services sector, although that's the one that's important to all of us today. We do an interview that's for every single industry that we serve, I think 18 industries in total. The scope of the interviews is across 64 different countries, so it's fairly substantive in terms of geographical reach and industries. We tried to take a geographical representation and an industry representation that would be balanced, and we balanced that based on contribution to the various countries' GDP. So you can see financial services sector represents quite a significant portion of the respondents at about 26%. And North America, I think, because of the size of GDP here, is about 37%. So quite a bit of representation that's relevant to us here today. Looking at the topics today, I believe the study has relevance to almost all the sessions that we're going to cover, from risk management to collaboration to technology improvements, social media, etc. So I think hopefully throughout the day you'll be able to reference back some of the things we talked about this morning and have it add a little bit of color to the rest of the presentations and roundtables and open discussions. As part of our analysis, we sought to understand differences between responses of CEOs in financial outperforming organizations versus underperforming organizations. So the categorization was really self-categorization. So if you look at how companies report financials and how they report how they've performed, only about 50% of the data is publicly available. So we relied on the responses primarily on the CEO's self-assessment as to how their corporation was doing relative to its peers. So you saw a fairly heavy concentration of people that felt that they were doing equal as well as their peers, a certain group of people that felt that they were outperforming, and another group of people that were underperforming based on the CEO's self-assessment. These self-assessments were also quantitatively analyzed together against some of the CIO and CMO studies that we had done earlier in 2011. So we cross-referenced the companies that had done this response, the CEOs that had done this response to the other CXO studies that we'd done, to see if that there was any type of correlation between their responses, the CEO's responses, and the CIO's and the CMO's responses. And interestingly enough, it came up fairly close, 80% match between what the people who work for the CEO felt that they were doing, pretty close in terms of where they felt they were. So we feel fairly confident too, based on some of our consulting experience and experience with these customers, that the assessments were fairly good as well. And based on the data that we got from them, we got basically about 99% data coverage off this just really deep, intensive performance survey that we did with them, data coverage across all the industries, so fairly important. So the study itself, the study's divided up into 5 chapters, and the first gives some background to the world of the CEO and puts it in context to the interconnected organization or ecosystem that it finds itself in. So when I say interconnected, I mean interconnected between customers, interconnected between employees, interconnected between the corporation and its trading partners, interconnected between its competition, interconnected between other industries. So what we see, and you've probably seen some of the commercials around Smarter Planet, we see the world is becoming smarter, but it's also becoming much more linked. That things that were barriers to entry for different types of companies and different industries to get into financial services are coming down, primarily because information is really what's commoditized inside of the world. So we felt that this was timely. This was the time to talk about what is a CEO doing to adapt in this interconnected world. And we came up with 3 major things that CEOs were doing based on this and based on the responses that we got from those. Empowering employees through values. And this is important, I'll talk about a little bit later. But there's this whole notion of control in an interconnected world where you tell people what they have to do and you enforce what they have to do, et cetera. But in this interconnected world, we're moving more towards an open world where people have much more latitude and much more flexibility and ability to change and do things on their own. So there's this structure of values that needs to be propagated throughout the companies in order to adapt to this. This is probably the most important insight, and it expresses itself throughout the study. Engage the customer as an individual. Really get to know the customer, know detailed what they want. If it's a newly married person, are they looking for a home? Are they 5 years, 10 years married? Are they looking to start, 529 plans for their kids? Are they retired and looking to draw down on annuities, et cetera? So being able to really understand what your customer is, what your customer's relationship is to you, know how that you can cross-sell, upsell, you can retain, and that you can take business away. Knowledge of the customer was key. And then it expresses itself not only inside of the normal operations of a business, but certainly in terms of risk management, et cetera. So these are big parts, right? Amplifying innovation through partnerships. And I'm going to talk about, just because it's top of mind for me right now, I'm probably going to mention Google about 3 or 4 times throughout this presentation, but if you look at some of the things that Google is doing today with near-field communications and creating basically a credit card inside your cell phone and partnering up with financial services institutions like American Express, et cetera, new entrants in the market that are really taking away a significant chunk of what we do as banking and financial markets institutions. How do we either capitalize on that or learn how to compete against it? And those are going to be big things, and partnership is certainly the thing that the leading CEOs are looking for to be outperforming. Okay. So in our research, we tried to figure out whether this connectedness factor, social media, transparency of information, et cetera, is actually critical to our CEO strategy and how it affects their decision-making day to day. So This is an interesting slide, and it's probably one of the more divergent slides for banking and financial markets. So one of the key findings in our CEO study was that across all industries, and when I say across all industries, I mean the average of all industries, not necessarily each individual industry. Across all industries, technology actually has taken first place in terms of the factors that are affecting decisions and how a company, how a CEO is actually addressing business challenges. And this is a first. I mean, we've been doing this study since 2004, and you can see back when we first started it, it was number 6, so fairly far down on the path. Over the last 3 or 4 studies, it's had a separate consistent rise, and now it's at number 1 across every industry, across all these different CEOs that we reviewed. Now, there is a fairly significant departure, though, for banking and financial markets, and that's on the right-hand side. So if you look at banking and financial markets, the top 1 and 2 are regulatory concerns and macroeconomic factors. So this is direct result of what happened in 2008 and the follow-on regulations, as well as companies just being concerned about their own solvency. So you see a real point-in-time tip in banking and financial markets, pushing up these things that are really, expressed through the crises that we found ourselves in the last 4 years. However, technology has popped up inside of banking and financial markets outside of that as well, running in at 4th place, and market factors is number 3 for banking and financial markets. So that was the biggest difference between the different industries in banking FM. There are a bunch of others as I go through the presentation, but it does have serious implications, because if all of our efforts and focus across multiple industries are on enabling the consumer, focusing on knowledge of the customer, etc., your customer is not doing business with just you. They're doing business with the automobile dealership, they're doing business with the supermarket, they're doing business with all these different things. And if those things are changing in their lives, yet we are focused on the regulatory concerns and solvency concerns, which we have to, because we need to make sure that we keep the wheels on the car as we go down the highway at 55 miles an hour, or 65 or 75, or depending on which company. But everybody else around us is advancing. We're going to find ourselves with customers with lowered satisfaction in terms of our knowledge of what the customer wants and our ability to service them adequately. And that will leave us vulnerable to alternate industries coming in. And so I mentioned I'm going to bring in Google a bunch of times, but if you have Google out there focusing on knowledge of the customer and creating a payments platform, all of a sudden, and you're focused on solvency and risk management and not as much on knowledge of the customer, et cetera, you're going to find yourselves at a loss, because they'll be able to better service and better know your customer than even you, and provide some innovation. So it's important, and it's definitely right that it's up there at the top, but it doesn't mean that we shouldn't be focusing around the rest, otherwise we'll be left behind. Okay, let me see. Let me make sure I'm at the right spot where I'm supposed to be. Okay. So banking and financial market CEOs' values are very much aligned to the other industries, with a focus on the customer and enabling of the talent as the number 1 and 2 priorities for this one. But there's a slight flip in terms of brand versus product innovation. So while other industries are trying to figure out how to build a better mousetrap, we're focused on repairing our brand image in banking and financial markets, which is understandable also based on what happened in 2008. But they're fairly close, and the brand focus can likely be attributed to that, and it's really, we've taken a beating in our industry over the last 4 years. So let's get a little bit deeper into the top 3 things that drive outperformance with our CEOs. Empowering employees through values. I think I mentioned this at the beginning of it. How do you actually create the framework so that everybody knows what to do in context? so that, in context of who they work for, in context of the situation, in context of the interaction. Engaging customers as individuals. This is more than just being able to know your customer. It's also being able to infer what the customer wants. It's also being able to look at interactions that they have, whether it be through social media or other business partners. It's also being able to have predictive analytics capability and being able to understand what they might do or what they're probably going to do. And then finally, it's the ability to act on all that knowledge, because just being smarter than your competitor doesn't mean that you're necessarily going to be able to do the right thing at the right time. So that actionable intelligence is incredibly important. And the last piece is amplifying innovation through partnerships. And our outperformers in banking and financial markets are the ones that do things more creatively and more rapidly with the assistance of business and technology partners. So, we're not just locked into doing things through our own shop, that we're able to pick the components that we can outsource, pick the things that we can strategically align to, whether it be through another industry, another trading partner, or a technology vendor, to be able to do that. Okay, where am I? Okay, so CEOs see greater organizational openness ahead, but as the rules are refined and collaboration explodes, how will they avoid the chaos and protect the business as well as deliver the results that are expected? Control is an important part of this. So control has delivered benefits over the years. It helps enforce regulatory compliance. It helps get to standardization. It helps you avoid waste. It also allows you to improve efficiency, so you're able to get the lower costs. There's upside potential, though, with openness, which is the flip side of control. And with openness, you get empowered employees, you get creative employees, you get innovation, you get people who can do more with less knowledge. So if there's collaboration and openness, they can reach out across the aisle to someone in another silo within the organization and take advantage of those things. So in banking and financial markets in particular, we found that the firms who are outperforming are the ones that embrace that openness and collaboration, and significantly different from the rest of their peers in banking and financial markets. And probably the biggest delta between the outperformers and the just business as usual folks is in the balance between control and openness. And so I'll talk about the delta. This is, and I know it's hard in the corners to see this. This chart explains where banking and financial markets is compared to every other industry in terms of that balance for industry average. This isn't even the outperformers. So industry average on the openness portion of that collaboration, the ability to extend reach for employees, is 44%. In banking and financial markets, its average is 32%. So quite a different terms of weighting in banking and financial markets, and some of it's to be expected because of regulations, because we're a highly regulated industry. But part of it is just culture. Part of it is that we've been grown up in an environment where we've been told to do what to do for so long. It's sort of by rote that we do that. So there's a balance that's needed with banking and FM CEOs to be able to figure out what can you let go of, what are the things that you can allow your employees to do. And you can see the difference there too with control. We're similarly flip side or inverse on the control side. We have 46% more weighting on control for the banking and FM CEOs versus our other industries at 33%. Now, here's the thing that made me believe that this isn't just a regulation thing. This isn't just a highly regulated industry. The outperformers in banking and FM, the ones that are doing the best in terms of profits, in terms of growth and revenue, are the ones that balance that openness to 48%. So they're actually higher average than the other industries. So it just should be some food for thought in terms of what we do for collaboration as we move forward and how we empower employees. Okay. Let me make sure I'm still on the right part. 12. Okay. Okay, not surprisingly, as follow on to the last slide, banking and financial markets are a bit behind in terms of banking and collaboration externally, and to some extent internally. So you can see that on the top two numbers. But they're investing in technologies around decision support. So while we are heavy on the control, we're also trying to make that more automated rather than enforcing it through regulations and pushing that down. And one thing that we are doing well in terms of adapting to that is creating this culture of ethics and values, corporate culture of ethics and values, and educating the people that work for us in terms of how to act as an employee, how to respond to a specific situation. Okay. So I mentioned a little bit about a real rise in ethics and values. So this slide talks a little bit to that. So you can see our industry average for educating our employees on ethics and values and what our CEOs value for the employees that work for the firm is actually higher than all the other industries. So that should be a good takeaway, that we're trying to create an industry that's truthful, honest, and dealing on the up and up with our customers. You find that ethics and values is a focus. It tends to work out in terms of the employees as well. On the flip side, that collaborative environment based on the other stuff shows that we're a little bit behind. We're a laggard on that. And purpose and mission, we're a little bit of a laggard there. And for the rest, it pretty much tracks. So we are really trying to do that through a framework of corporate culture. Okay. So CEOs are establishing that culture, as I said, in which employees not only connect more with each other in the outside world to innovate, but to reinvent themselves. They're learning from each other. They stay ahead of the skills curve. They're open to change, and it essentially makes the employees future-proof. Collaboration is the #1 trait CEOs expect from their employees, and this is the same for banking and financial markets as opposed to every other industry. So while we may not be putting into place those capabilities directly with our workers, we value that higher than anybody else. A little bit of a flip too in terms of product innovation. You think of banking and financial markets for the most part as being fairly staid in terms of what types of things that we offer to our customers. So product innovation is actually a little bit lower on the curve than the rest of the industries for the CEOs for banking and FM, but flexibility is much higher. And what that means is that while the products themselves may not change, how we package them, what channels we use to go out with, what business partners, trading partners that we use to actually execute, how do we implement better ways of doing business with the customers so that they feel the impact of the products that we have to offer and that we're more insightful as to how we work with them. I want to make sure too, organizations that are outperforming their peers are 30% more likely to emphasize this open culture concept. And so that's a fairly significant trait and characteristic. It's often characterized by a greater use of social media as a key enabler. So if you're looking to see how your culture is within your financial services firm, social media is probably a key indicator as to whether or not you're adopting and you're taking on this open collaboration. Okay, so the next pillar of this study, which is engaging customers as individuals. So CEOs are searching for customer insight, but even if they discover it, are their organizations equipped to respond with relevance and speed? They effectively engage, the outperformers effectively engage an individual customer, client, organizations. They have to weave these insights from the whole person. So if you have multiple products, multiple silos within your organization, knowledge of the customer and how it interacts with you is critically important. If you have interaction with the customer as a bank, but it's also the customer is obviously buying cars, going out and buying homes, etc. Knowledge of how they interact with their other business partners is important to how you do business as well. So being able to weave together a holistic view of that customer, not just from the information you know about them or could know about them based on your own interactions with them, but about what they're doing outside of your interactions with you, can glean incredible insights as to how to better retain customers, better service customers, and better gain market share. 73% of CEOs realize that they need to meet new customer expectations and to be engaged as individuals. This goes to a little bit to what I said earlier about multiple industries affecting customers' perception of what we do with them as an industry. So if we're able to do things in the context of healthcare, but we're not able to do something that should be done similarly, like inquiry, the ability to transact business, the ability to pay things, the ability to purchase coverage versus purchase a new financial services product. If we're not able to do those things, those are going to impact whether or not our customer feels that we're actually servicing them correctly. So to that point, CEOs are investing in analytics for customer insights more than any other functional area. In banking and financial markets, there's one little twist to that, and it goes back to the regulatory and compliance portion, whereas the rest of the industries really aren't spending much in terms of insight and analytics around regulatory and compliance. Banking and financial markets is up at 64% for that. I want to make sure that I don't run out of time too, so we got 15 minutes, thanks. Okay, so focus on customer insight is not limited to analytics, but extends beyond to inference, context, and action. Enablement of the customer to act is especially prevalent where we're seeing large focus on consistent capabilities across channels. So think about mobile apps that you may extend out to your customers. Are they able to do the same things that they can on a laptop? Are they able to do the same things that they can through the branch? Are they able to do the same things that they can through telephony, et cetera? So consistency of interactions is important, but not just consistency of interactions, but knowledge of how those interactions flow between different channels and different modes is incredibly important to our customers as well. So going back to the thing about actionable intelligence, incredibly important to our CEOs in this study as well. And finally, being able to increase transparency and corporate accountability is important not just for the survival of the firm, not just for regulations, but also important for faith from the customers and the employees. So we find that more and more customers or financial services firms are communicating that ability to survive and thrive, not just out to the people who are asking for it, but the people who they interact with on a daily basis. Okay. Social media is the least utilized means of interacting with customers and employees today. So you'll see that from banking and financial markets. It's just really low. I think it's 9% of total interactions today. But all of our CEOs said it will be, face-to-face will still remain number one, but social media within 5 years will be the number two way that companies interact with employees and with customers. So it's a key takeaway. If you're dabbling now, it's time to start thinking about a 5-year strategy, because the rest of the firms are saying this is going to be the game changer. CEOs, as I said, are investing in analytics for customer insights more than any other functional area. I think I got that. Banking and FM in particular is ahead of other industries in this category, but new technologies, increased complexity of products, higher systemic risk, and more demanding customers require that we continue to improve. So, this particular slide, the emphasis on this takeaway is, the outperformers are, going out to access data more, draw insights data, turning it into actionable intelligence. at a significantly higher rate than their competitors on the average and their competitors that are the underperformers. So if there was a key takeaway as to what customers are or what financial services firms are doing better, it's definitely the data, knowledge of the customer, and being able to act on the data. Not surprisingly for financial services, right? Okay. Amplify innovation with partnerships. So nearly 70% of the CEOs are aiming now to partner extensively. And if 70% of the CEOs are saying partnership is the way to go, how do you differentiate? What if everybody's trying to do it? How do you differentiate? Well, the rising complexity and escalating competitions has made partnering a core innovation strategy. And able to sustain it, fruitful innovation of partnerships, organizations will need deeper, more integrated relationships. They'll need to enable close working relationships among staff of the partnering firms, not just the executives. And also, in a partnering environment, it's not about vendor-client or competitor or co-opetition to co-opetition. It's about everybody wins. So figuring out how the business relationship turns into something where both partners can succeed is critical to being able to develop an innovative and self-sustaining partnering relationship. So you can see too, partnering from a business and technology standpoint has risen dramatically over the last 4 years. It's gone up 25% in terms of CEO's priority. And banking and FM are still slight laggards compared to the rest of the industries, so there's room to improve here. Compared to their less successful peers, outperformers in financial services are partnering for innovation more aggressively and tackling more challenging and disruptive types of innovation. So looking to actually change the business. And forget if it was Butch that I talked to earlier about this, but I think about some of the things that are happening from disruptive innovation from collaboration standpoint. I mentioned Google already, but those near-field communication devices within the phones that are going to turn into the payments platform of the future. And then if you look at Google again from an insurance standpoint, although I don't know if they've actually talked about this, but you've probably heard of the self-driving car from Google that you can get behind the wheel and it just takes you along this incredibly complex course at high speeds and has 0 accidents. It doesn't hit anything. If we're in this environment where a self-driving car takes accidents down to near 0, what does that mean to the automobile insurance industry if people start adopting that? It's going to disrupt the entire ecosystem for financial services, at least on the insurance side. So I think that disruptive technologies, whether it be from ancillary industries or from within our own industry, will actually be the game changers as we go into the next decade. So banking and FM still slight laggards compared to the rest of the industry, so once again, room to improve here too. So CEOs told us 3 leadership traits are most critical to steer their organizations effectively in the connected world. Inspirational leadership, which will engage, motivate, and guide employees, and shared purpose rather than tight control. So going back to creating that open and collaborative environment. The customer obsession was the #1 for banking and financial markets, as well as #1 for all of our industries. And it'll drive the organization toward deeper, more contextual insights. And leadership across the C-suite, and I think this is a little bit different than some of the other stuff that we've talked about, is walking the walk and talking the talk. So when you say you want empowered, open, collaborative employees, that you act as though you trust your employees and you open up, you give away some of the control that you've got. So while we haven't seen that uptake as significantly in banking and financial markets, we know it's one of the goals and things that they value. So hopefully as it starts progressing, they'll start taking that up. Okay. So there's a couple of things that I want you to be able to take, and it's in the presentation itself. There's Institute for Business Value app, which has much deeper insights than what I'm able to go into in 45 minutes. Can get down deeply into any one of these areas, and there's actually very specific actionable items that CEOs are asking their employees and their companies to do, as well as what we feel are the best practices approach to do that. Of course, some of those are going to involve IBM, but it's a real valuable app, and it goes deeper into the study. I think in the thumb drives that we gave to you as well, we have the whole study for all industries so that you're able to read it. It may be better, I think, to read as you're going to bed rather before you go into a drive, because it is fairly substantive, but you can glean a lot of insight from it as well. And then finally, there's the ability to follow up on any single area into this with self-assessments and take the study itself. So if you're interested in seeing how your company measures up to the rest of the industry, you can do that too. And that's on the left-hand side here. And the last thing here is I've left my name, my contact information. My position is fairly simple. I lead software group sales for financial services, banking, and insurance worldwide. And so I have a little bit of say in some of our strategies, so I'm very interested in what our customers want us to do. So if you catch me during the morning sometime and tell me what's really bugging you, or if you have questions about this presentation, I'd be more than happy to talk to you about it. So thank you very much.